In this video, I'll show you how to use one of the most popular indicators in TradingView, the RSI, or Relative Strength Index. It's a simple tool, but a lot of beginners use it the wrong way. So instead of just looking for random overbought and oversold signals, I'll show you how traders actually use RSI to read momentum, understand market structure, and spot potential reversals more effectively. Let's get into it. First, head over to TradingView and open the chart layout. From here, go to the Indicators tab at the top of the screen. Now type in RSI, which stands for Relative Strength Index. You'll see the built-in RSI indicator appear right here. Open the first one on the list. As soon as you add it, the RSI panel will appear underneath the main chart. The RSI is a momentum indicator. In simple terms, it measures how strong recent price action has been. So when the market moves aggressively higher with strong bullish candles, the RSI usually pushes up as well. And when price starts dropping quickly with strong bearish momentum, the RSI moves lower. You can see that pretty clearly on the chart here. Now, one of the most common ways traders use RSI is by watching the 70 and 30 levels. When the RSI moves above 70, the market is considered overbought. And when it drops below 30, it's considered oversold. These areas can sometimes signal that price is becoming stretched and may be ready for a short-term reversal. For example, right here, the RSI moved into oversold territory, and shortly after that, price started bouncing back higher. But this is where many beginner traders make mistakes. Just because RSI is overbought doesn't automatically mean the market has to crash. And just because it's oversold doesn't guarantee a reversal. In strong trends, momentum can stay elevated for a long time. You can actually see an example right here. The RSI was already above 70, but price continued climbing even higher afterward. That's why experienced traders usually combine RSI with price action and market analysis instead of using it completely on its own. A much more useful technique is something called RSI divergence. This is where price and momentum start moving in opposite directions. And it can help reveal weakening trend strength before a reversal becomes obvious on the chart. Here's an example. Price creates a high and then pushes into a higher high. But if you look at the RSI below, the indicator creates a high followed by a lower high. So while price is technically moving upward, momentum is actually slowing down. This is called bearish RSI divergence, and it can sometimes signal that buyers are losing strength and the market could reverse lower. This setup is commonly used in technical analysis because it gives traders additional confirmation instead of relying only on overbought and oversold levels. And once you start combining RSI with support and resistance, trend lines, and overall market structure, it becomes a much more powerful tool for analyzing the financial markets. If you enjoy clean and beginner-friendly TradingView tutorials focused on real market analysis, subscribe for more weekly content.